companies will not have a choice but to shed labor to preserve their profit margins. Unless we want to basically say that not only has the business cycle been repealed, which is what the soft landing advocates would have you believe, but we'll have to also say that the United States has ceased to become a capitalist economy.
If you look back at 2007, the recession started in December of 2007. The S&P made a new high in October of that year. So not a very good forecast right now at that point. And I think that you had a very similar view of the consensus of economists at that point that we were going to have a soft landing. Today, the updated numbers are something like 68% of money managers think we are going to get a soft landing.
We have another very special panel with two esteemed guests, David Hay, co-CIO of Evergreen Gavekal, and David Rosenberg, founder and president of Rosenberg Research. And of course, I'm David Lynn, so we'll call this episode David Cubed. Welcome, gentlemen. Honored to be hosting both of you together at the same time. I've spoken to both of you individually. You've got excellent thoughts. I'm very excited to be having both of you together. Welcome. Thank you.
Thank you.
Thank you, David. And for me, it's such a privilege. I've read David Rosenberg's research for 20 years, going back to his Merrill days. And he's just one of my heroes. And I owe him a debt of gratitude because it was his work back in 2005 and 6 and 7 that really convinced me there was a massive bubble in housing, and particularly, dodgy mortgages, and really helped us protect our clients from that, what I call the implosion of Bubble 2.0. So this is truly a great honor for me.
Well, great honor for all of us. Both of you are the audience's heroes, so excited to get your takes. I want to start by talking about macro first before we talk about what's next for the Federal Reserve and the specific asset classes that you like or don't like and market performances. But first, let's talk about, you've both written about GDI, gross domestic income. It's been negative for the first quarter, which in the past has been indicative of a coming recession, if we're not already in one. David Rosenberg, let me start with you first. How are you reading this stat?
Well, real GDI isn't just negative in the first quarter. It was negative in the fourth quarter, and it's been negative in 3 of the past 4 quarters. And in fact, it's running negative 0.8% year over year at a time when real GDP is plus 1.8% year over year. So we have this dichotomy going on between the national accounts. GDI represents the income accounts. GDP is GDP. It's all about spending. So there's a gap here between the income side and the spending side. Now, look, if you go back to last year, there was this period where we had successive declines in real GDP. And all the pundits out there were saying, well, ignore the back-to-back declines in real GDP because GDI is still positive. And what they were saying is, just wait, GDP will end up gravitating to where GDI is. And they were right. What's interesting is that we have positive GDP, but we have negative GDI, and nobody says a word about it. You see, they sort of swept that under the rug because it doesn't fit the bullish narrative. But what we have to know historically is that when we have real GDI negative year on year and back-to-back quarters of decline, that has been a recession signal back to 1948 only 100% of the time. And what you find historically is that it is GDP. For all the people that think that we're in a soft landing, well, look at the spending numbers. Remember that the spending numbers have a lot of imputations on the service sector side. We are a service sector economy. A lot of the spending, especially as it pertains to real estate, but also other services, are imputed by the government statisticians. The thing about gross domestic income is that there are no such imputations. So what people are going to find that they'll be surprised, and this is what's happened in the past when you get these divergences, and this is a whopper of a divergence, but we know that over time, the national accounts have to balance. What we also know is that GDP ends up following in the tracks of GDI. So that's why it's important right now to focus on the divergence, because what people don't realize today as they look at this false glow of the economy from a spending perspective, not being ratified by the income data, is that the spending numbers, the GDP follows GDI, not the other way around. So for those people that think that maybe we're in a recession right now, I understand that the stock market doesn't see it, but the stock market stopped being an economic indicator a long time ago. It's a momentum index right now. The people that are saying that we may have already entered into a recession, when the revisions come in on GDP, will have been proven correct. And I'll just do another reminder. Nobody thought that the recession started in December of 2007. December 2007 was when the Great Recession began. And most people didn't even realize it because they weren't focused on income. They were focused on spending. Most people didn't start to forecast a recession until Fannie and Freddie went into conservatorship in the summer of 2008. The recession was already 6-7 months old. That came as quite a surprise, but not to the NBER because they're always late because they're very methodical. And they dated the recession back to December 2007 when everybody and their uncle or aunt were calling for a soft landing. Go figure that one. And then you go back, I can go back cycle after cycle. The recession began in March of 2001. The tech wreck recession. Who was calling for that? Nobody. Most people calling for recession. Do you know when? After 9/11. The consensus moved to a recession call and out of a soft landing call in September of 2001. The recession had started in March of 2001. So this is what I mean about recessions, is that they're like an odorless gas, Yeah, it's like it sneaks up on you when you don't expect it. And it usually happens just as when the feverish pitch from the consensus is that we're in a soft landing, which is exactly where we're in right now. But keep in mind that GDI is what doesn't suffer the same statistical impurities that GDP does. That's why it's important.
All right, excellent. I'll let David Hay respond. Going on David Rosenberg's analogy of an odorless gas seeping into our system, why is it that the markets have a gas mask on, or at least that's what it seems?
That was a good one. Well, and David just pointed out that that's been kind of a recurring pattern to this idea that the stock market is anticipatory and a great forecaster. I mean, maybe that was true at one time, although I do believe somebody once said that it had forecast 9 of the next 5 recessions. So you got a lot of false negatives in effect, but lately it's been different, lately being the last 20, 25 years. So to his point, if you look back at 2007, the recession started in December of 2007. The S&P made a new high in October of that year. So not a very good forecast right now at that point. And I think that you had a very similar view of the consensus of economists at that point that we were going to have a soft landing. Today, the updated numbers are something like 68% of money managers think we are going to get a soft landing. And that's so contrary to not only GDI, but if you look at the yield curve, and of course, David has written on this extensively as I have, that some people say, well, you can have an inverted yield curve and still get a soft landing. Yes, if it's mildly inverted and it doesn't last very long, but this is a deeply inverted yield curve that has lasted for a long time. The odds are basically 100% of that. When you see the LEIs, the leading economic indicators, down for 14 straight months, the odds of recession are basically 100%. You start putting all these things together and you go, man, you got to have some, real guts or, perhaps recklessness to believe that we're not going to have a recession given that data. So I think you just have to kind of do a reality check, but it's kind of like these financial and economic narratives are being written by the creators of, Stranger Things, where you just have this kind of upside down situation where I keep hearing that, for example, and I think Josh Brown is very smart on CNBC, but he just said last week that we're getting a surprising amount of economic data that is surprisingly strong. And that, basically there's no sense of the economy rolling over. Jamie Dimon, who I also have a tremendous amount of respect for, just said the economy is very resilient. So to that point, I want to bring up something that I haven't seen David write about, and I'm interested in his take on this. But what I find just amazing is if you look at nominal GDP at, say, 5 or 6% right now, and yet you look at the deficit spending, the deficit percentage of GDP is like 7 to 8. So if you back out the federal red ink, you've got actually somewhat negative private sector growth. I mean, I don't see how that's resilient at all. It strikes me as being incredibly reliant upon the federal government spending at a level that is, in my view, completely unsustainable. But David, what do you think about that?
Well, I think that there's this metric, it's going to support everything you said, which averages out real GDP and real GDI. And when you average out the two, you're talking about, say, real growth barely at 1% year over year, which is basically stagnant on a per capita basis. That's being charitable if you want to take a look at both comprehensive measures of the economy and the income and spending side. So I think that's, you could argue that's where we are. We're sort of in a flattish economy. I said before that, I wouldn't be surprised if the recession's already started, and I wouldn't be surprised if we're still in a state of purgatory. I think these people that talk about how great the economy is doing, I mean, even if you go and you accept the premise from the Atlanta Fed nowcast model for the second quarter, it's a little more. It's about 1.5% on real final sales. I remember in the days where Stephen Roach and Morgan Stanley would have coined that stall speed. And that's where you are when you're in a soft landing. So I think the problem here is that we are in a soft landing. But the question is, are we going to remain in a soft landing over the course of the next year? A soft landing is a resting spot between the prior economic expansion and the future recession. And I'll tell you the truth, I speak about a recession to clients and to most people. It's as if I look them in the eye and I'm telling them that their kid is ugly. I'm not giving anybody a medical diagnosis here. People seem to think that recessions are some evil thing to be always avoided. But the reality is that we're in an expansion 85% of the time, thank the good Lord. And we're in a recession 15% of the time. Recessions aren't unicorns. They're actually attached to recessions, to expansions, and expansions are attached to recessions. And the point I'm making is that if you go back, 2007 was a soft landing year. Did you want to tell anybody in December of 2007 that the soft landing is going to be something perpetual in 2008? What a bad call. The year 2000 was a soft landing year. Did you want to tell anybody that we're going to be in a soft landing? You go back to, 1989 was a soft landing year. So everybody's talking about the soft landing. Yeah, we've been in a soft landing. The Fed started raising rates in March 2022. The yield curve inverted about a year ago. And the lags between the Fed and the lags between the yield curve, as all economists will tell you, they are long and they are variable. But the day of reckoning comes. And the reason why we got perpetual soft landings or no recessions in the context of a Fed tightening cycle in the mid-60s under McChesney-Martin, and in the mid-80s under Volcker, then the mid-90s under Alan Greenspan, when he managed to secure the title of Maestro. Only 3 times historically have we had Fed tightening cycles result in a non-recessionary economy. And that's because in those 3 episodes that I mentioned, the Fed stopped tightening before the yield curve inverted. Now we have the Fed tightening policy recurringly and ongoingly into an inverted yield curve. Now, I know that Goldman Sachs put out a report saying, well, because the term premium is so much lower than average that the yield curve is giving you a bit of a distorted signal. And Goldman Sachs reduced their economics department. They took their recession odds to 20% from 25%. But you see, Jay Powell let the cat out of the bag in March 2022, when at the press conference after the meeting, he was asked about the yield curve, which at that point was flattening precipitously. And he says, we don't take a look at the yield curve that way that Wall Street does. We don't look at 3 months 10s or 2 years against 10s. We look at the money market curve. And he specifically said that the research at the Fed showed that the most appropriate yield curve from a forecasting standpoint was the 3-month Treasury bill yield spot benchmarked against the 18-month forwards on the 3-month bill. And when he said that at the time, with a certain degree of glumness, he says that yield curve right now is over 200 basis points. So no problem. And he said if that yield curve ever inverts, and this has nothing to do with the yield curve that Goldman Sachs is looking at. We're looking at the Powell yield curve. He said at the time, if it ever inverts, it's telling us the economy is supremely weak and that the Fed's going to have to cut. That's a direct quote. And as we sit here today, that Powell curve is negative 130 basis points. And nobody ever asked him about it. I don't think that the media are allowed to ask him about that because, of course, he's still raising rates. Direct quote, March 2022, when this Powell curve inverts, the Fed's supposed to be cutting and the economy is supposed to be weakening. But that's not happening. But that is a bellwether. Back to what David Hay was saying, that is telling us that a recession is staring us in the face again if it's not here already. And that's the major point. There is no better barometer or forecasting tool than the yield curve. And if you don't like 2's 10s for the reason that Goldman Sachs is telling you to ignore it, the Powell curve itself is telling you that we're heading into recession. The irony is that the Fed is still tightening into that. And that comes down to Fed credibility. And nobody calls out Powell. This curve is inverted. You told us if this curve inverts, you're more likely to cut rates. And you're still threatening to raise rates 2 more times. And I'm just amazed that nobody ever calls Powell out on this or dares to even ask him a question.
Okay. David Hay, I'd like you to respond to that. And in particular, I'd like to ask you whether or not you think the S&P 500 will reach new all-time highs before a possible correction. And the reason I ask you is because if we assume, or the markets assume that a soft landing is possible, wouldn't markets continue to rally on that belief?
They certainly could. I mean, that gets back to the anecdote or the factoid that I just cited about October 2007, leading up to what was one of the most cataclysmic downturns, going back all the way to the Great Depression. Yet the S&P made a new high. So it's certainly possible. I mean, trying to predict what the market's going to do near term is a fool's errand. And I don't want to be any more foolish than I've been sometimes with some of my calls. So I'll pass on that one. But I do think what we're seeing is a broadening out of the market. There's just no question. It was such a narrow market through May. And I did actually write a piece in mid-June where I said that, the consensus view was that that's a sign of a very unhealthy market to have that, bad breath, that halitosis, if you will. But I said the other thing, so everybody's worried about that, what could happen would be a broadening out. And that's exactly what was actually happening at the time and has continued to happen. So there are some parts of the market that look actually quite attractive, totally with David on Japan, but even looking domestically, the energy sector, which has been absolutely brutalized after a couple of great years. And if you like momentum with, at least reasonable valuations, I think XLI is very interesting, which is the industrial ETF. I think a theme that we both believe in. In fact, I saw some charts in his daily today from David showing the tremendous surge in domestic manufacturing for plants, building plants, I should say. And I think that reindustrialization of America theme has considerable legs. So it's certainly not all glum out there by any means. I don't want to say that, but I do think that it's disingenuous for the no landing, soft landing crowd to be doing this victory dance when you've got some very tangible recession evidence right there. I mean, for example, the profits recession, which you would think stock market people would care more about what's happening to profits than the overall economy. So we've got almost certainly 3 quarters in a row of falling profits. And that's a recession. And if you look at the manufacturing sector, that looks to be in recession. The trucking industry is it's fishtailing right now. You've got a cardboard recession, which is important. So many goods, both industrial and consumer, are shipped, in cardboard boxes. And as David said, you've got a GDI recession. So that's, those are 3 at least. I mean, kind of 2 of them are under the same category that we're in recession. So I think that it's a bit naive to think everything is really resilient and robust, and those are, a couple of descriptions I continue to hear. So yeah, I think I think that's where you've got a danger, is that as the reality sets in, as it did in past soft landings that morphed into hard landings, that's really kind of the sequence David was describing. That's when the giddy consensus really has a nasty wake-up call.
David, hey, just a quick follow-up on that, and then we'll move on to David Rosenberg for response. What happens if, let's say, we do get a recession on paper and everyone recognizes that it's a consensus and the Fed recognizes that, but the core PCE is still above 4%. Currently, it's at 4.6. And so you've got a recession and inflation higher than still the Fed's target. What will the Fed do in that scenario? Will they still raise rates?
I doubt it. I mean, I think that there's a rate hike coming before the end of this month. After that, I think, that could be it. Hard to know. But I think what's really going to cause the Fed to start aggressively easing will be a dramatic rise in unemployment. I don't think it's going to be just the economic numbers, which, as David said, are oftentimes revised. And so it's hard to know in real time, are you in a recession?
Because I keep hearing that the Fed will, raise rates until something breaks. And, in this scenario that the economy starts breaking, but the inflation rate is still high. Well, what do? They still have to fight the inflation mandate, right? That's where I'm coming from.
Yeah. Well, I think they will, if unemployment is going up enough, they will say that's going to lead to further disinflation. And they're already picking up on these very clear disinflationary trends. So I think they'd have plenty of cover to be able to do that. But I don't think it's anytime real soon. And that's where I think there's going to be another disappointment for the bulls who are hoping for a quick pivot. Dave may have a different view of that.
David Rosenberg, what's your outlook on the labor market?
The labor market is a lagging indicator, okay? And you have a central bank that's focused on contemporaneous and lagging indicators, all right? Unemployment rate and your labor costs are in the index of lagging indicators. David Hay talked about the Conference Board's leading economic indicator. It's down 14 months in a row and has provided, once again, 100% recession signal. And guess what? The stock market it's one of the components. You want to know what the labor market, labor cost unemployment rate in the index of lagging indicators, non-farm payrolls, which everybody worships, the first Friday of every month, is in the index of coincident indicators. What are the two labor market components in the index of leading indicators? And there's only two, is the work week, which has been contracting, and pretty well at the same level today it was back in April 2020 when most of the country was locked down. The work week is a leading indicator because hours lead bodies. And although companies have been like the boy with a little finger in the dike and trying their best to hoard labor, they've been cutting their hours. But hours worked are a leading indicator for anybody that likes to drive looking through the front window instead of the rear view or the side view mirror, all right? And initial jobless claims are the other leading indicator, and they have been hooking up irregularly for the better part of the past 6 months. So I think that we're going to be seeing some cracks in the labor market, but they usually happen after the recession starts. That's my view on the labor market. David Hay accurately said that we're in a profits recession. When profits go down, when corporate income goes down, companies respond by preserving their margins by cutting their costs, and the biggest costs are labor. So my view is that the labor market is going to be shifting into a disinflationary development and will be one of the factors that underpins the recession. But more often than not, employment only starts to go down if the recession starts. The unemployment rate only starts to go up once the recession starts. So we're really predicting here what a lagging indicator is going to respond to from everything else that's happening with the economy. The labor market is always the last man standing. I know that everybody's always interested in the labor market, but it's a lagging indicator. And in terms of the comment before about the stock market, can it go back to the highs? Maybe it can. We have a 19 plus multiple on the S&P 500. So you're talking about, an earnings yield that is inferior to the yield that you get on the risk-free rate. So investors are chasing the market. This is a momentum-driven markets, right? When investors start to pile in because they're bowing down to the holy grail of price momentum, you get a melt up. And it's not based on fundamentals. It's based on speculation, momentum, technicals. That's what's driving the market right now, and sentiment. But make no mistake, the market multiple, I mean, it's not a great timing tool, but think about as an investor what you're paying for. You're paying for an earnings stream. And you're paying for an earnings stream taking on capital risk, which is why you should always be mindful of the equity risk premium, which has been ground back down to well under 100 basis points. So it's a very expensive market, straight up and benchmarked against risk-free rates. And the stock market to me reminds me of the clown at the circus blowing up the balloon and blowing up the balloon and blowing up the balloon until the balloon will finally just pop in its face. I heard on CNBC today, commentators saying several times, I think it was on Squawk Box, that FOMO is here to stay. Did you hear that? FOMO is here to stay. It reminds me of Irving Fisher in 1929 saying, and he was an astute investor, that we are at a permanently new plateau on equity market valuation. How well did that turn out? FOMO is here to see what I'm saying here. You're asking us about the stock market that's being driven. It's breathing fumes of momentum. So, of course, it can go to new highs. Is it rational? No. Can it happen? Yes. Will it be sustainable? Well, I've never actually seen the stock market rally through a recession. Maybe in the second half of the recession, normally the stock market bottoms, the real bottom is 70% of the way into the recession. This recession hasn't even started yet. And by the way, even if you have a soft landing view, like the 68% of fund managers, the market is still stupid expensive. So I believe in buying low, selling high. Right now, we are basically almost back to peak multiples in the context of an earnings recession. And the Fed is not relenting. So you can't even say that, oh, well, I'm going to rally the stock market because the Fed's going to cut rates. They're not giving you that indication one bit. So it's really a speculative market right now. And if you want to play the momentum, may the force be with you. But what we find in the past is that rallies that are not backed by fundamentals are rallies you can rent for several months. They're not rallies you can own.
So let me just chime in there, David, if I can, that, I agree with that totally, though I do think it is kind of a tale of two markets. And that, I mean, for example, this is kind of classic of the current zeitgeist out there, which is one of the most popular and famous CNBC talking heads was saying just the other day that, just buy the top seven, the Magnificent Seven that we all know well, and it's just easy. And whenever somebody says it's easy to make money in the financial markets, I just think, I've been doing this 44 years, and whenever I think I've got it made and things are really going my way, it's because I'm on the wrong lane. The traffic's going to be coming right into me. So I think that's a dangerous comment, and I think it's extremely dangerous and really highlights in hard data forms just how concentrated this market is. When you've got the NASDAQ 100 7 companies represent 50% of the NASDAQ 100. The point out David's written on this, that the keepers of the NASDAQ 100 index are alarmed at that concentration, as they well should be, and are actually taking measures to try to diversify it more. Maybe that horse is out of the barn and running down the country road, but it's certainly the right thing to do. But as David said, the equity risk premium is extremely unattractive right now. And if you look at the Warren Buffett indicator, which looks at the stock market relative to GDP, it's even higher than it was in 2000, early 2000, at the peak of the greatest stock market bubble in human history, or in American history, I should say. Japan's was worse in the late 80s. So it is a very expensive market. And the other thing that I thought David was going to touch on with the labor market, and perhaps why it is so misleading at times like this, when you are going through kind of a soft landing inflection point, is the birth-death model. Because the birth-death model is a big reason why non-farm payrolls look still quite robust. But if you back out those adjustments, which are very imputed, to use David's term, you're actually seeing contracting job growth in the last 3 months on a 3-month moving average basis. So a very, very different reading. And I think that's one reason why unemployment is such an unreliable, kind of the ultimate lagging economic indicator. And David's right, you need to look at some of the leading ones, like the quit ratio, which is deteriorating, or initial claims. And I believe I know they're rising at least 40 states. I think it's actually closer to 45 states are seeing rising initial claims for unemployment. So that's a good heads up too. So yes, I think my core message here is that all the celebration that we've avoided a recession, I think is way premature.
David Rosenberg, I'll just follow up on that. The latest headline inflation number came in at 3%, which is slightly lower than consensus. Do you think that a lower inflation reading, at least compared to last year, would incentivize consumers to spend more?
Well, look, I think that it's a hard question to answer because so many things go into people's spending decisions. I think that if you just said in a static world, declining inflation is going to boost real incomes, therefore we're going to spend more. Yeah, absolutely right. But when you're doing a consumption function, it's got more than one variable in there. So I would say that it comes back to what we said before. The unemployment rate is going to be going up. In fact, you're starting to see the U6, the broadest measure of unemployment, is actually going up rather considerably over the course of the past 6 months. Labor market slack will lead to lower nominal wages. So if you have this real income perspective, the question is who's going to win the race going down, inflation or wage rates. So that's something we have to consider. But ipso facto, declining inflation would be positive for real spending. But at the same time, if we're having labor market slack and if we're having companies respond to not just the profits recession, but also the fact that if there's something in the U.S. economy that is really in decline, it's productivity. Not every day that productivity is down year over year about 1%. How do companies normally respond to productivity? If they can't boost their orders or output, they have to shed their labor. Like I said, they're starting to do that on the hours work side. Employment will come next. So what happens is that not only do you get wage rates coming down, but you're going to have contracting employment. And that's going to mitigate what's happening on the inflation side. Something else to keep in mind on the inflation side. What does it mean when inflation is going down? It means that these two curves are shifting in a funky way, demand and supply. When inflation went up to 9%, we had constricting supply, but demand was booming. But now the supply curve is normalized, and now demand is starting to subside. Now you can argue that demand isn't contracting if you look classically at GDP. But I mean, 1.8% year-over-year real GDP growth gives everybody this false glow. I've got news for you. The average year-over-year growth rate in real GDP on the eve of every recession going back to 1948, okay, this is the average, the norm, 3.3%. That's why when I talked about the odorless gas, it hits you like a 2x4. Do you know that heading in, that's why people think that we're in a soft landing, and then they believe that the soft landing is going to persist. But nothing persists. Nothing is permanent. So historically, the average GDP growth rate heading into recession is plus 3.3. We're at plus 1.8. The only other cycle historically where heading into recession, the 4-quarter trailing trend in real GDP was heading into the 1980 recession. Maybe that's appropriate because that was the first of 2 Volcker recessions. And we have a central banker named Jay Powell who likes to compare himself to Paul Volcker whenever he gets the opportunity. So that's where I fall out against that backdrop. I think that it's going to be challenging for incomes because wage rates, even if they go down in line with inflation, we're going to be getting contracting employment. The question is really going to be how much. Companies will not have a choice but to shed labor to preserve their profit margins, unless we want to basically say that not only has the business cycle been repealed, which is what the soft landing advocates would have you believe, but we'll have to also say that the United States has ceased to become a capitalist economy, that the corporate sector will no longer respond to negative productivity rates to shore up their profit margins by keeping their labor input where it is. There is nothing in economics, in theory or practice, that leads you to a conclusion that employment market's going to remain strong or even stable in the next 4 quarters. It's going to contract.
David, hey, can you respond to David Rosenberg's inflation comments? Do you think inflation is going to stay low?
For a while, but not indefinitely. And he was talking about the U.S. perhaps morphing into more of a state-controlled economy, or words that effect. And I'm not trying to misquote you, David, but I do think that is one of the longer term inflationary forcings is this move towards an industrial policy, more state capitalism. There's a gentleman by the name of Russell Napier who for many years was in the disinflation camp along with David Rosenberg and myself. And he's really done a 180. And one of his beliefs is that things like the Inflation Reduction Act are not just one-off, that this is a real trend throughout Western economies and particularly in the US. And that what they're going to do, and you're already seeing evidence of this, is to, in many cases, provide not just direct funding from legislation like the Inflation Reduction Act, but loan guarantees. So for pet projects, and particularly related to what I call the great green energy transition, that they will provide a very attractive financing, which makes it real attractive for somebody like Ford to build an EV plant. But of course, that doesn't show up on the balance sheet of the government. So that's more like indirect deficit spending, of which we're already doing an enormous amount. And the fact that the government is running 7 to 8% deficits of GDP when you've got sub 4% unemployment is just, to borrow a term from Princess Bride, it's just inconceivable that that's happening. And I think that's got some significant inflationary implications long term, because I do believe that we're getting to a point where this idea that the federal government can constantly spend without any kind of negative reverberations is coming to its sell-by date. And I think the second half of the year, I know you've heard somebody say this before, David Lynn, that we could have this real fiscal funding crisis, possibly even a failed treasury auction. But at some point, I just don't see how the Fed can avoid stepping back in with its magical money machine. So basically starting QE again. I don't think that's going to be right away, but I think at some point over the next, say 6 to 18 months, that becomes an increasing probability. And by the way, I don't think Jay Powell will go along with it. I think Jay Powell will resign before he goes back into the QE mode. But that's a rather radical prediction. But one thing I wanted to ask, David, it relates to a lot of this stuff that we're talking about, and we have this intense debate internally is, so David Rosenberg, how much of what we're seeing that looks bad is because we're comparing against what was so strong a year ago. So instead of the base effect, more it's the peak effect, whether it's looking at the money supply growth or on inflation or unemployment. And so are we being fooled by what were just unbelievably high numbers that were not sustainable and things were really just kind of getting to normal, but the fall off has been very pronounced. So I guess it's kind of a stock flow type of argument or discussion.
Well, actually, the real distortion happened a year ago off 2020. 2020, I should actually say 2021 coming off 2020. That was the really big boom. There's no distortion. The things weren't like super strong this time last year. So there's no base effects when we're talking about, real GDP or employment, because we had the cataclysmic down in the winter, say in spring of 2020. And then, of course, it was in early 2021. We had two big fiscal stimuli. We had Trump with giveaways in January. And then we had the Biden budget buster in March, stimulus checks for all. So that was an early, call it first half of 2021. And so that was a gift that kept giving. And so that skewed the growth rates in 2021 and then there's a subsided. So I don't find that there's any, we can talk about base effects when it comes to inflation, but in terms of the economy, most of the big run up, we're talking about, we're coming off a high base and that's distorting the numbers to the downside. That was really the story 2 years ago on a year-over-year basis, not right now.
I would agree with that.
Now, if I could just comment, on the inflation side, there's thousands of variables that go in. Look at and I really appreciate Russell Napier as well. But, a lot of the inflation mongers came out. I remember Larry Lindsay going on CNBC talking about inflation and 6% interest rates after Trump got elected in 2016. And he got the tax cuts through at a time of full employment. And he was going to build an immigrant wall around labor, which he did. And we're going to get the big inflation. Well, it never happened, right? Like before COVID, we had 3.5% unemployment, about where it is now. Inflation was around 2%. The 10-year Treasury note yield was about 2%. The Fed funds rate was 1.75. That was with a 3.5% unemployment rate. So, I guess that was big inflation narrative didn't happen. Now everybody coming out of COVID, and the stimulus, and we're going to have big inflation in the future. I don't know. I have an open mind towards deglobalization. I've heard that for many, many years. I don't know how much that shifts the dial. Government intervention in the economy, I don't know. Japan has had huge government intervention in its economy for decades. It has one of the lowest inflation rates in the world till this day. China is a communist country. Talk about state intervention, and they're in the process of deflating. And look at the state intervention there. So I don't know. FDR carried through one of the most epic government interventions of all time in the 1930s with the New Deal. And it's not clear that never really brought the economy out of the Great Depression, and never brought the economy really out of its deflation. And World War II did. So, look, I'll keep an open mind. I can't say that I'm convinced by all these inflationary arguments. I know that aging demographics cuts both ways on demand and supply. Supply of labor goes down, but demand for goods and services goes down too, because people, once they retire, they spend less. Maybe they'll spend more on hip replacements and cruise lines, but generally spending goes down a lot per person after the age of 65. And we find historically, looking at the cross-section of data, that the demand impact from aging demographics is more powerful than the depleted labor supply. Demand is more important than supply. Actually, you tend to find that the most aging populations tend to have the lowest inflation rates, curiously enough. So we know aging demographics are going to be with us for at least another 10 years. That's a disinflationary force. And the one thing we haven't talked about, and of course this comes down to the previous question of the labor market, is what's this new technology, this generative AI? And this is actually, it's maybe not the internet, but it's certainly bigger than 3D printing. It's actually going to, I think, put in a lot of labor market uncertainty. It's going to shake things up. It's going to create winners and losers, but it's going to generate more uncertainty in the labor market. I think it's going to have a downward impact on wages and likely end up being a game changer on productivity, and productivity is an inflation killer. So there's other things happening at the same time. And when I throw it into the blender, I'm not so sure. I think that I adhere to Bob Fittle's 10 market rules to remember. One of the market rules is that there are no new eras. Excesses are never permanent. So I think that just like F. Scott Fitzgerald wrote The Great Gatsby in 1925. There's not a mention of the Great Inflation. We had 5 years of double-digit inflation from 1916 and 1920. We had, and this is the last time we had a war, and we had a global health crisis collide with each other. We had 1 month of 9% inflation, and people lost their marbles. We had 5 years of double-digit inflation. And once these shocks ended, we normalized towards no inflation for a decade. And then, of course, 1929, we started deflation. We had no inflation from 1920 to 1929. F. Scott Fitzgerald has a temerity in 1925 not to even mention the Great Inflation 5 years earlier. You know why? Do you know why? Because it was forgotten. And I think that this inflationary episode is going to be forgotten too.
Well, I think one big difference versus then was what the government was doing. The government was running surpluses. The debt to GDP level was actually falling through most of the 1920s. I still get back to this idea that, how can we continue to have 7-8% deficits during basically full employment, and what's going to happen in the next recession to those deficits? And that's why I worry that we're going to get into a situation, especially as these unfunded entitlements, which Jeff Gundlach says 150 trillion present value. Stan Druckenmiller says 200 trillion present value of, things like Social Security, Medicare, Medicaid. And as those are increasingly coming onto the budget, that's just, we can't even service the existing debt stock, much less all the unfunded entitlements. How do we get out of that without having to resort to the Fed's printing press? So while we could have cyclical disinflation, and we're in the throes of that right now, when you've got a system that's as highly leveraged as ours is, and of course the government's the worst offender, but not the only one. We've got a tremendous amount of debt in certain parts of the corporate sector, a lot of which is floating rate. And I think this is actually going to feed into our joint view of a recession is as these guys, increasingly have to default on their debt at, 10, 11, 12% interest rates where they were barely able to stay in business when rates were 5%. So, and I think that's, where there's real risk. Maybe the traditional banking crisis is over, but the shadow banking system, that has the potential to be quite ugly. So, how does the Fed react if these things really start blowing up? Do they let the system implode? I think what they did during the banking crisis is telling. I think it indicates that they're not going to stand by and let the system kind of flush it out. They will be very creative in their triage efforts and try to prevent a kind of deflationary bust that we had in the 1930s, which of course is what followed the 1920s. I mean, we could have, I guess you could say we could afford it back then, just like Volcker could go to 20% on short-term interest rates because the debt to GDP was down around 25% back in the late 70s. It's very difficult to do that in this highly leveraged system that we're in today.
Look, I'll just say that if government debt was all that mattered, Japan would been in hyperinflation a long time ago. So I'm trying to explain that inflation is very complex. It has hundreds of variables. I can't sit here. I guess we could debate one variable, which is government debt. I said before that FDR did not produce inflation with the New Deal. So other things are happening at the same time, and you have to also talk about what is the offsetting impact it has in terms of the crowding out effect on private investment. What's happening to private debt at the same time? You have to take a look at the entire debt pie, and then you take a look at how is aggregate supply interacting with aggregate demand. It's very complicated. I'm not going to get into it right now, but I'm not going to get lured into a debate with a one single equation to call it inflation. It's much more complex.
Okay. I'd like to move on and finally talk about preferred asset classes. David Hay, I'll let you go first. In light of everything we've discussed so far in your macro environment outlook, which assets will likely outperform and underperform?
Well, let's just say that going all the way back to the early 80s, whenever we got to this kind of a situation, late economic cycle, inverted yield curve, I extended duration for clients. And typically with very high grade long-term bonds like, treasuries. I'm reluctant to do that this time. I think the sweet spot is kind of in the 3 to 5 year range for all the reasons I talked about. That's why I think that it's so important to have a view of the federal government's fiscal situation. And is it truly getting to the point where it's unsustainable and is going to require a reaction function that they haven't previously used? So where I think it makes more sense if you're going to bet on declining long-term interest rates is to focus on the stronger emerging markets, where frankly, I think they're behaving much more responsibly from both a fiscal and monetary policy standpoint. They were quick to tighten when inflation started getting out of control in early 2021. So you look at countries like Brazil, where the policy rate, the equivalent of the Fed funds rate, is in the mid-teens and inflation's down in the 4 to 5% zone. That is very much like Paul Volcker. And a number of other emerging economies have had that, huge real interest rate. So I think if you're going to extend duration, it makes more sense to do it in some of those stronger emerging countries, and particularly where their currency is undervalued, which is the case with quite a few of them, though that's changing. We look at the Mexican peso lately, it's been on fire. So I think this one, because our circumstances are so radically different, and I hear David about, look what Japan's been able to get away with, but Japan is a massive creditor country. They owe that debt internally. The rest of the world owes them, trillions of dollars, whereas the U.S. is a huge debtor country now. So I think it's a very different situation between the U.S. and Japan currently. So I think that's a way to play it. But, Japan itself looks attractive, as David already indicated, their equity market. I think the yen is a great way for U.S. investors to play the end of their nonsensical yield curve control that they continue to pursue. If they let interest rates start to rise to a more normal level, I think the yen will have a huge up move. And I think that's just a matter of time. But I also think in the U.S. market, when David and I both agree that there's a lot of overvalued stocks that, some of these magnificent seven that are actually seeing disappointing revenue and disappointing earnings, and yet they're trading at 30, 35 times earnings. And what is it? Google, Apple, and Microsoft are trading at a higher cumulative value than the entire emerging markets. equity market. They have 6 billion people. That's just crazy. So you've got this incredibly concentrated U.S. market, but among the cheaper stocks, they're actually far below, about 30% below on a valuation basis, their normal level. So it's like money's been just this great sucking sound that's moved the money from the other parts of the market, particularly the value and the deep value parts, into the Magnificent Seven and a handful of others. It is very reminiscent of what happened in the late 90s, 1999, early 2000. And if you were disciplined enough and brave enough to say, I'm not going to follow the herd, I'm going to go where the real values are, you did just fine during that brutal bear market that ran from 2000 to 2002. And I think we're going to see a repeat of that.
Okay, same question to you, David Rosenberg.
Yeah, look, I'll just say that for the U.S. market, growth stocks are way too expensive. The value stocks, to me, are value traps in a recession. And I'm very bullish on the Treasury market. I think you're getting paid 5.5% to be in Treasury bills. Why wouldn't you take that? And I'd want to be barbell between the very front end of the curve and long bonds, because the one thing we know about mean reversion is that the yield curve will mean revert. We're only inverted 15% of the time. This is not sustainable. How will it normalize? Well, it's too late to be normalized by the back end of the curve. That would have happened already. So it's going to normalize by much shorter short-term rates, and long-term rates will come down by less, but because of the convexity, it's going to give you a nice total return. I think the Treasury market will give you equity-like returns in the coming 12 months. Outside of that, within the U.S. stock market, I like the rate sensitives. The telecoms have been beaten down pretty badly. That includes utilities, healthcare. I'd even say select REITs. So I like rate sensitivity because of my rates calls. So I'm not saying that people have to go out and buy barbed wire, baked beans, and canned tuna. There are spots in the stock market that make sense to me, and it's all priced off of the two most important things that we should always talk about, which is interest rates. In terms of global markets, the U.S. trades at a 19 multiple. The 51st state called Canada trades at a 13 multiple. As much as a no-brainer as there ever is, I recommend to our American investors on the call, take your cash in your chips in the U.S., move them north of the border. 13 multiple against 19 multiple. Think about that earnings yield gap. It's a 2 standard deviation event. And our top stock market globally has been and remains, and this is from the Perma Bear, has been Japan. And I'm not worried about the yen. I'm not worried about yield curve control. Japan is going through a secular re-rating because of Abenomics is finally taking hold in terms of a whole new equity culture taking place in Japan. Japan Inc. finally returning cash to shareholders. Look at dividend payout ratios, dividend yield in Japan. It's a very compelling story. And I think it's a secular story. Japan right now, and what's happened here is that the fund flows that have driven the Nikkei up, 26% year to date, that's been foreign money coming in. The locals haven't even played a role yet. Wait till that happens. This reminds me of the equity culture that began. People don't remember that there was a time when the U.S. did not have an equity culture. There was a time when there was no CNBC. There was a time when the U.S. stock market traded at an 8 multiple, and that was back in August 1982.
Yeah, to David's point, Japanese households.
That's what Japan looks like to me. A secular re-rating.
Totally agree. And to his point, Japanese households only have about 10% of their net worth in equities versus 40% in the U.S. Even in Europe, it's 20%. And he mentioned 13 multiple on Canada. That's actually about the multiple, at least on forward earnings for the Nikkei as well. So, and it's had a huge breakout. So I guess the only caution I would say is to run a lot lately. And, I would say there's probably likelihood of a pullback, but I think it's a pullback to be bought. So we're in agreement there. And I think, I guess one thing I would say about Canada, I think one reason that market is so inexpensively priced is because it has a lot of energy exposure. And the U.S., the same thing. If you look at the energy sector, it just looks, a 14% free cash flow yield on trailing, which can be a little misleading because earnings are coming down due to the lower prices, but still even at today's energy prices, you're at about a 9% free cash flow yield, which is tremendous. So recession fears are way more than discounted in the oil market currently. And I actually think that we're going to see two things that happen this recession. They're going to be very different. One, I think oil prices go up in the recession. And number two, I think long-term treasury rates go up in the recession. I think the yield curve is going to get steepened because short-term rates are going to come down a lot and long-term rates actually go up on fears of getting paid and depreciated dollars. And that's where I think Dave and I have the biggest disagreement right now. That's why I'd rather play that with emerging market debt on the longer end.
Excellent. Well, I thank you both for your time today. David Rosenberg, where can we follow your work?
So just you can go to information at rosenbergresearch.com or just Google Rosenberg Research, take you right to the website. And in fact, you go in there, 30 seconds to fill out the application, and voila, you'll get a 30-day free trial for everything that we do.
Okay. And David Hay?
Haymaker_Substack. Pretty easy to find us there.
All right. Well, thank you both for your time again, and excellent discussion. We'll speak again soon. Thank you.
All the best. Thank you very much.
Thank you, David.
You too.
Thank you for watching. Don't forget to subscribe.